P in the 4 Ps now, which is pricing. We've just spoken about product and placement or distribution in our other lecture overview. Then we spoke about promotion, and I broke the video so that we could focus now on pricing. So this video will focus on the final P in the 4 Ps, pricing. So we will now talk about pricing objectives in the marketing mix. Business people attempt to accomplish certain objectives through their pricing decisions. Okay, we'll see some of those featured on the screen. We see skimming pricing, penetration pricing, bundle pricing, premium pricing, psychological pricing, cost plus pricing, a lot of different competitive pricing, a lot of different strategies that businesses will use. So let's look at some of those in more detail. There are multiple strategies for pricing a product and or service, but most businesses generally will use what's known as cost-based pricing to calculate their total cost per unit, and then they'll add a markup. Here's what I want to make to cover overhead costs and generate profits. So for example, going back to my scissors, I can make these scissors for $1, and I know that, and I want to make a couple dollars off each sale. I'm going to charge $3. So you're figuring out what your base cost is, and then marking it up so you can generate some profit. Some other strategies businesses use. Okay, this is a big one, and this is something that will also be helpful in our financial analysis and statements overview we'll be doing later on in the course. So this is what's known as a break-even analysis. This is a pricing technique used to determine the minimum sales volume a product must generate at a certain price level to cover all those costs. So we can help figure out if we have a product at a certain cost point and we sell it at a certain price, how many of those we need to sell in order to make sure we're not losing money, which is a really valuable tool. So there's 3 different factors you need to know in order to do a break even. You need to know variable costs. These are the costs that change with the level of production, things like labor and raw materials. A good way to think of variable costs, these are things that change with the number of sales. For example, if you own a restaurant, the amount of costs you have in French fries being sold will vary based on whether you have 1 customer or 100. However, a fixed cost will not vary depending on the number of products sold. No matter how many French fries are sold, they still have to pay that 1 employee, however much wages. They might sell 10 things of fries that day or 100, they still will get that same hourly rate. That's what's known as a fixed cost. That will be stable regardless of the production level. Another example of that would be insurance fees, the rent you might be paying on the space. And then the last factor is a sales price for your product, what you will sell that price, the product for to the public. So this is a really important pricing technique, and you'll see a formula on the screen here. To find that break-even point, you're going to take those fixed costs, those total costs that are not changing, and you're going to divide them by the amount you're selling the product for. So for our scissors, it might be the $3 minus the average cost per unit for the scissors I told you was $1. So on the bottom of that equation, it's $2. Each time I sell scissors to someone for $3, it costs me $1. I can put $2 in my pocket. Okay? But that $2 doesn't just stay in my pocket, right? Because I have other fixed costs. I need to pay the employee, so maybe I need to make some money for selling this. I need to pay for the rental space for the space that we're in. Those are fixed costs. So I'm looking at the bottom of this equation at each time I sell a product, how much money the company is making, and then I need to put that money towards some of the fixed costs, the rent, the employees. So how many scissors do I need to sell if I make $2 off each to cover all of those fixed costs as well? On the bottom of the equation, these scissors being sold for $3 is the average price of the unit, the average price of the scissors the customer will buy. The average cost for me to make them is $1. That's the variable cost. Okay, and then at that, 3 minus $1 is $2. That's known as the profit margin. It's how much money is made off of each product sold. That's going to divide into the fixed costs, those total costs you have that are unchanging. No matter how many of these scissors I sell, I still need to pay, $3,000 in rent, and I still need to pay my employees $5,000 that month, and the insurance and the phone bill and the internet bill. So how many times do I need to sell scissors and get those $2 to ultimately cover those costs? That's where that break even is so helpful. So let's look at an example to help illustrate that. Okay, first of all, we jump straight from, I'll show you that explanation in just a moment. So think about a jewelry making hobby in a business. You have $1,000 per month of fixed costs. These are things like your studio rent, your utilities, and the equipment you use for the jewelry. Then your variable costs for each necklace are $50. That's for any of the materials for the jewelry, the beads, the string, the clasp, and the labor, the person who actually makes the jewelry. Then you'd like to charge $70 a necklace. You see that other necklaces are going for that price, people seem willing to buy at that price, you think that's a good price point. So plugging in those numbers, we take the $1,000 of fixed costs that are unchanging. We put the price of $70 you plan to sell, and then for each necklace, remember it costs us $50 to make it, we do that equation out and we find that we need to sell 50 necklaces a month at $70 each in order to break even. Taking that number, you want to think about, does that seem practical? Do I think there'll be 50 people coming in and buying this necklace at that price point? You can compare different pricing strategies then. For instance, if you raise the price to $80, you only need to sell 33 necklaces, but it might be harder to attract buyers at that price. So you want to think about, if you make it even lower, maybe you sell it for, $60, could you attract more than 50 buyers? While you're making less money off each necklace, you need more customers to buy. It might be more likely more customers buy at that lower price point. So it can be a really valuable tool to figure out your pricing, and also you might decide to cut your expenses. Maybe you need to find a way to make it cost less than $50 if you can only sell it for $60. How can we make it so that we can produce it for $40 so we still make $20 off each necklace sold to go towards our fixed costs? So really, it's such a valuable tool in understanding the cost of your business and making a good pricing strategy. This video gives you a useful overview of this really important concept in 3 minutes. So I'm going to show you this now on the screen. For more videos about how to calculate break even, if you're struggling with this concept, you can also take a look at this link.
Break-even and cost volume profit analysis explained in 3 minutes. When can you say a business is good or not? Quite simply, it's good if the money earned is more than the money spent. However, a business has to spend on long-term stuff and short-term stuff. For example, if your business spends on a new shop, this is a long-term thing. If it spends on the cost of lemons because you're selling lemonade in the lemonade shop, this is a short-term thing. When we say that a company breaks even, we are generally only comparing money earned against the short-term stuff, like the ingredients which go into your lemonade, the salary you might pay to your lemonade maker and shop manager, the insurance and rent for your shop, advertising of your lemonade, taxes for your business, and other similar things. When you earn enough from selling lemonades to pay for these short-term things, we may say that a company has reached its break-even point. When you're not selling enough lemonades and not earning enough to pay for these short-term things, your business is said to be losing money. When you're selling more than enough lemonades to earn more than enough money to pay for these short-term things, this extra earnings is called profit. So when you're at break-even point, you're not in a good situation, but you're also not in a bad situation. You have no profit, but also no loss. If you're still starting out in your business, you of course want to target reaching break-even point so that you don't lose money. Break-even analysis is when we try to find out how much sales we need so that your business can break even. But after a while, you'll want to do better than break even. You'll want to have some profit as well. So when we try to find out how much sales we need to be profitable, do we still call this break-even analysis? Normally, no. We now call this cost volume profit analysis, or CVP for short. With cost volume profit analysis, we try to find out how much sales we need to reach a certain target profit. So anyway, that's the super simplified explanation of break-even and cost volume profit analysis.
So hopefully that video also gave you another way to look at break-even analysis, and it helped explain how you can also try to use cost volume profit analysis to determine how to build a certain profit in your business. Moving on from break-even analysis, we're going to also talk about some other forms of pricing strategies. Skimming pricing is when you're setting an intentionally high price relative to the prices of competitive products. The idea here is to distinguish a firm's high-end product from those of competitors. A great example of that is with computers. Apple charges significantly more for its computers than Dell or other companies do. And in doing so, they still, because they have such a strong brand value, we've seen in this course, they're still able to attract buyers. And the focus here is that they're hopefully giving a better quality product. So, you might decide to purchase an Apple computer rather than a Dell, paying $1,500 for something like this, when you could have gotten, a similar computer from Dell for $400 because you prefer the quality and benefits that Apple offers. That's what we call skimming pricing. It's almost like they're offering this type of luxury brand and you're willing to pay more, even though the price is so much more. It's saying, hey, it's better quality, it's worth it. Penetration pricing is where you're setting a low price as what we call a marketing weapon. It's often used with new products. And again, this isn't just low cost pricing, it's really a marketing weapon. So for example, on the market, Apple had these Apple TVs for $100. Well, Chromecast came out with a product that could do something similar in streaming video content at a price of only $35. So you see a huge price difference there. And suddenly, while someone might want to stream media but not be willing to pay $100 to do that, they're able to get a lot of buyers to pay just $35 to do something similar. It's an interesting way for a business to take an advantage on the market. Now, that's different from what we call everyday low pricing or discount pricing. That's more what we think of when we think of Walmart. And here we're going to have continuous low prices. Rather than just doing a promotion and like a short-term basis, a buy one, get one free, Walmart is a company where they will almost always offer these kind of low-cost buying options. And they're able to do that. Going back to my scissors example, if it cost me $1 to make these scissors, I charge $3. I'm getting $2 each time. With 5 customers, I get $10. Walmart, they're able to say, hey, I'm going to charge just $2 for those scissors. It costs you $1 to make them. They're only making $1 on each sale. So they're not making as much money. But suddenly, because it's a lower price, they're able to sell more of them. They sell to 10 people, they still get $10. And they probably will be able to sell to those 10 people because of the fact that it's a lower price point. So that's what we mean. It's a lower profit margin, but more people are more likely to buy. So that's what we mean when we talk about this low pricing, discount pricing. That can be an effective strategy, but it might not be associated with the same type of quality that you see in skimming pricing. Competitive pricing is another really popular pricing strategy. Here we're reducing the emphasis on price competition by simply matching other firms' prices. So to use competitive pricing, which many of you may use, you're going to look at least a few different firms out in the market. Remember, it's important to benchmark the competition. So if you're trying to figure out how much do I sell these scissors for, we're going to go look at other companies like Target or Amazon and see what they're selling for there. So we look at Target, Amazon, and Walmart, and we see a range of $1 to $3. You might decide to sell them for $2 to fall within that range. Okay, keeping your price within the market price. Now, another piece of pricing that's really important is our perception of the price. Marketers have to think about how customers perceive products based on that pricing. So in price quality, a higher price means prestige, higher quality, and vice versa. If it's a lower price, a customer might think, hey, that's not going to be, the best product. Yes, I can get these scissors for $1, but maybe they'll break in a week, whereas the $3 ones will last longer. So there's a little bit of quality association that customers perceive with a product in terms of its price. Odd pricing is another way that we can strategize pricing with a customer. This sets prices in uneven amounts or amounts that sound less than they really are. So for example, you might sell something for $1.99 instead of $2. Really, it's about $2, but it just sounds cheaper by doing it at that $1.99 price point. Okay, so odd pricing can also be an effective pricing strategy. Here's some of the difficulty in pricing. Think about how much you would pay for this watch. We can see a logo on there. We see Chanel, so it's probably a little expensive, and so you might be willing to pay more for that. But it could also be a knockoff and only be worth like $1. It's not really that authentic product. So it's really hard to determine what to price this at. So you need to think for a customer, just showing them the product. A bunch of you might yell out, I'll pay $10 for a watch. Well, it has some diamonds on it, or it's a specific luxury brand, I'll pay $10,000 for it. There can be such a range. So you really want to find the right price. Think about your strategy, think about your target market, and again, use that market research. It might just be as simple as going out there, showing people this watch and saying, how much are you willing to pay for this? Talking through some of the value and benefits, and you'll find a good price range from that. So we've talked now about each of the 4 P's: product, place or distribution, promotion, and finally pricing in this overview. I hope you enjoyed our overview of the 4 P's of marketing to help go a little deeper from our introduction to marketing. And please use these strategies as you think about how to communicate with your target market in helping to build revenue for a business either you own or one that you work for. If you're creative and you're interested in these topics that we've talked about in our marketing overviews, marketing might be the right path for you. Thank you.